Hey guys, welcome back to CBO Wellness, Chill Vibes Only. My name is Allie, and today I'm going to be talking about how I invest my money. I did a video a few weeks ago on how I track my spending and how I budget my money on a monthly basis, which I'll link down below in case you're interested in watching. But part of that video, I talked about how I used my savings on a monthly basis to invest my money and grow my wealth over time. So today's video is breaking down how I do that, how I started investing, and I'm sharing this with you because I hope it's helpful in allowing you to feel confident to look into investing and to start to invest your own money, because it's actually quite simple. And sometimes I think people make it seem more complicated to scare you off or to feel like you need someone to help you with this, but you have all the power and resources to start investing on your own. And my one goal for this video is just to get you thinking about that and open-minded to starting, because I think when women have control over their finances and their wealth and their future finances, it gives us more power. And it's really helped me with being able to plan for my future. And so if I can help someone else, I want to be able to do that as well. So for context, I live in Canada. So I'm going to be talking about the Canadian types of investing accounts. So I started investing, I believe, when I was 18 years old, maybe 20. Once you turn 18 in Canada, you can open up an account called a TFSA, which is a tax-free savings account. There are contribution limits, so you can't just put all your money in there. Depending on your age and when you open up the account will determine how much you can contribute to that account. But the positive thing about a tax-free savings account in Canada is that any money that you make in that account is tax free. So when you sell assets and make profit, you can withdraw those funds and you don't have to pay tax on them. Whereas in a traditional investing account, anything that you made a profit on that you sold, if you wanted to take that money out, you have to report it as capital gains and as income. So you get taxed on it. But of course, you might run out of contribution room. So then there are other accounts you can consider as well when it comes to investing. But the first one that I always like to tell people about when they're starting investing is a tax-free account, because you might have a savings account that you're getting interest on, but that interest at the end of the year you have to pay tax on. Whereas if you put that money into a tax-free savings account and invested it, you wouldn't have to pay tax on the gains that you made. I opened up one of those accounts, and then after that I opened up an RRSP account, which is a retirement savings plan account in Canada. And then recently I also opened up a first-time homebuyers account, which is an FHSA, and that is for building wealth to buy your first home in Canada. After that, you can also always open up just a regular investing account, but these are just different accounts where you can put your money in to hopefully have it grow. And it's the first step when it comes to investing. So I would do your research on what type of account you want to open. Like I said, if you haven't opened a TFSA and you're in Canada, that's a great first account to open. But then there are also benefits to your RRSP and your HSA, which I'll explain in a little bit when it comes to tax benefits that you get for putting money into those accounts. So I opened up a TFSA, and basically any money that I saved throughout the month for my investments, I would contribute into that account. Obviously, check to see the contribution room. You don't want to over contribute to those accounts. So if your contribution room is at $50,000, you can only put $50,000 in. You can't put $60,000 in. You can put $40,000 in, but if you put in more than you're allowed to contribute, you will get penalized for that. So just make sure you know what your contribution room is. Once you invest your money into the account, then you can choose what you want to buy with that money in order to have it grow. So there are different things that you can buy in an investment account. So you could buy ETFs, you could buy GICs, you could buy bonds, you could buy stocks. And this is kind of where I think a lot of people get confused on investing, is that they think like, I don't know what to buy. I don't want to lose my money. It feels a little risky, but it doesn't have to be. And there's a lot of really wonderful things that you can invest your money in that will compound and grow over time. And if you take one thing away from this video, I hope it's this. It's not about how much you have to invest, like how much money you have. It's about the time in the market that you spend. There are tools called compound interest calculators where you can say, okay, if I have $10,000 and then I continue to invest $1,000 on a monthly basis for the next 50 years, and I am going to get a 7% return on that on average over those 50 years, what will that grow to? And you can see huge ways that you can grow your wealth just by simply staying in the market and being consistent about investing your income. When it comes to investments, there are different things that you can buy, obviously, but one of the most simplest ways I think you can get into the market is by purchasing ETFs. ETFs are exchange traded funds. And what that means is that instead of buying a singular stock, so say instead of buying Apple stock, whereas if Apple has a really good year, it might go up. If something happens, it might go down. You can buy an ETF that owns a part of multiple companies on the stock market. So you own a little bit of Apple and you own a little bit of Microsoft and you own a little bit of Loblaws and a little bit of Walmart. There are different ETFs that have different breakdowns of different companies, and you can look into those. There are also really great tools like Wealthsimple, I know, has a feature where it says the top ETFs that you can purchase, and you can see the breakdowns and the percentage too of like amount of fixed income versus stocks, so you can see the breakdown of the risk assessment. But what you do when you buy an ETF, you diversify your investment because a lot of these ETFs follow the stock market. So if the stock market's going up, they're going up. If the stock market's going down, they're going down. But over time, if you leave your money in those ETFs and those investments, the stock market historically has gone up. So your money historically will go up, and it's about leaving it in there for future, like when you retire, and then at that point you can start to withdraw based off of the base amount that you've grown it to. So for example, say if you save $2 million, and that's just through investing regularly, which is definitely reasonable to do. By the age that you want to retire, you can usually withdraw 4% every single year as a safety net that won't impact your principal amount of the $2 million, and that's about $80,000. And imagine you got your investment accounts in your TFSA to $2 million. That means that you can withdraw $80,000 tax-free to live off of for retirement in that year. So it's about staying consistent and working towards that final number, and having your investments in your ETFs give you a return on average about 7% over the 50 or whatever years that you're investing. And now that might seem complicated to you as well. And you might say, well, I don't want to research ETFs and I don't want to know which ones to buy. That's okay. There are also really great companies now, such as like Wealthsimple and Questrade, where you can do managed portfolios, but they're not managed by a person who's going to take 5% of your gains. They're usually lower percentage fees that you pay. And they say to you, okay, what's your risk tolerance? If you want maybe 80% stocks, 20% bonds, or 60% stocks, 40% bonds and fixed income. You can choose what you're comfortable with and what your average returns will be year over year, and they will manage and buy the ETFs for you. So I have a lot of friends who do that as well, where they're like, I don't want to do the research and do the self-directed. I want to just go with one of these companies. That's also a great way to get into the stock market without paying super high fees. That's how I would recommend starting to get invested. You would just open up any one of those investment accounts, maybe start with your TFSA, look into an ETF that you want to buy, or look into working with a company like Questrade or Wealthsimple, where you can have a managed portfolio and choosing your percentage. If you're a younger person and you're not going to touch that money for a long time, you might want to do, a more aggressive growth approach, which would be like an 80-20 split. If you're someone who might be touching that money sooner than later, then maybe you go more with a more conservative plan, which would be like 60-40. If you're someone who's getting closer to retirement and you're just looking to grow your money, you might do an opposite split. It really depends on you and your goals, but I highly recommend you use a compound interest calculator, type in what you want to be spending in retirement, figure out what that base number is, and then what you need to invest and how much your returns need to be year over year to get to that number. And of course, if you can always invest more, that's great, but it's more about consistency than the amount of money you're putting in. And of course, staying with the market through the highs and the lows and not trying to sell when you're at a low. That's why in my savings video, I talked about having that emergency fund. The emergency fund is so you don't have to touch your investments if something were to go wrong. You could live off your emergency fund while still letting that grow and go through the waves of the market. Now, I talked about the TFSA, but I do want to quickly bring up an RRSP and FHSA before I end the video. So those are two accounts where you are taxed on your gains, but there are some benefits, especially for first-time homebuyers in Canada. So in your RRSP, whenever you contribute money into that, you can actually claim that on your taxes at the end of the year as a deduction. So say if you put $10,000 in your RRSP this year, if you made $100,000, they would be taxing you like you made $100,000. But because you put $10,000 into your RRSP, you can claim that as a deduction. So the government's going to actually think that you made $90,000. And so they're going to pay you back that additional tax they charged you for when they were taxing you at the 100,000 rate. Then you get a nice juicy tax return and you can use that money to invest it if you want, or put it in a different account to let it grow. So there are benefits to that. Also, with your RSP in Canada for your first time home, you can take out up to $65,000, I believe, tax free. So if that money's growing for your down payment. And the same thing works for your FHSA, which is a new account. It's a first time home buyer's account. The limit every year, I believe, for contributions is $8,000. It's up to a max of $40,000. Anything you invest in there, you can take out for your first time house tax free as well. And when you invest in that, you can also do the deductions off your income. So it's a really great way to build wealth to buy property. And I highly recommend you check out that as well. So I hope this video was helpful for you in terms of how to get started with investing, and showing you how you can make your money grow for you over time. Investing is something that I think everybody should know how to do and should feel confident in asking questions and learning about it, because it's a really wonderful way to build wealth. And you don't want to be stuck, with your money in a savings account where you're only making 2% and paying tax on that every year, when you could be investing it and making 7%, 10%, even 20%, growing that money over time for you to have a really nice retirement fund. I hope you found this video helpful. If you have questions, please leave them down below. If you liked it, please give a big thumbs up and subscribe, because that really helps my channel. I know I talk about a lot of different things on here, but it's truly everything that I believe helps build wellness and makes women confident and secure in themselves. And I hope you guys are finding these videos helpful. Yeah, thanks so much for watching, and I'll see you for another video soon.